In another video, I talked about investing in a laneway suite or a garden suite, which typically costs somewhere between $300,000 to $400,000. You might think, doesn't it make more sense to use that money to buy another investment instead? Well, maybe. The thing is, deciding what to invest in is not a one-size-fits-all answer, and managing a build is definitely not for everyone either. But from a financial standpoint, the risk and returns are pretty different too. So let's dig into what might make more sense for you. But before I continue, check this out. Our sales team searches MLS every single day to look for the best freehold investment deals in Toronto. Even when you're not ready to commit to active search with our sales team yet, you can still get on our weekly top deals list if you are a client and have your financing ready. Just head over to the link in the description to learn more. Don't forget to like this video and subscribe to our channel so you don't miss other content like this made just for real estate investors in Toronto. Here is our scenario. You own a home where you can refinance and pull out $300,000 to invest in. With this money, you can build a 1,000 square foot laneway suite at $300 per square foot, or you can take the same amount and use it towards a down payment, closing costs, and potential renovations on another property. With $300,000, you can actually buy up to a $1.25 million turnkey property. But realistically, it's pretty hard to qualify for that these days. So let's look at a more likely case where you would buy a $1 million property and put in renovations instead. So as you can see, the amount of debt that you are borrowing is different right off the bat. With a laneway suite, you're borrowing $300,000 from the bank at 5.5%, for example. So you're paying back $1,700 each month. It's not that hard to qualify for an extra $300,000 of debt to build a laneway suite, but it definitely does get harder if you are borrowing more money to buy a new property. With a new purchase, you'll need to be able to qualify for $1.1 million of new debt. And if and only if you do, you'd still have to pay back $6,200 per month. The good news here is that rent does help pay for most of it. You might get $6,300 in market rent from a new purchase if you have 3 separate units combined. And after operating expenses and your mortgage payments, you would be cash flowing negative $600 per month because the entire house is funded by borrowed funds compared to a normal investment property that might only have 80% in borrowed funds. The laneway suite generates less rent at $3,200, but with lower operating expenses and a much smaller mortgage, you're actually cash flowing positive $1,400 per month here. So if you had the choice, it really does come down to your investing goals. If you're looking for large cash flows to subsidize your lifestyle, for example, investing in a laneway suite build becomes a much better option. On the other hand, a new purchase can give you better long-term appreciation. So let's assume we see 3% in annual market appreciation. So that's $30,000 per year on a $1 million purchase, but only $9,000 on a laneway suite if it's valued at cost. So if you add up your rental income and appreciation together, you still make more money investing in a new property. Obviously, this does change even more if you use different assumptions for appreciation. If we go with a 7% annual appreciation, which actually is the average for Toronto over the past 10 years, then the difference becomes even bigger. I also think it's important for me to talk about the downside risk here for a new purchase, which is also higher if prices fall. So if we assume a 7% depreciation, your position on the laneway suite won't change that much, but your mark-to-market loss on the new purchase would be a lot higher. Finally, I'll go over the value add portion a little bit too. Realistically, this can vary quite a lot, and there aren't many sales comps for laneway suite builds right now because they're still relatively new. But if we use cap rates to price them, then you'll see that the backyard house does have much better value add potential. Of course, you are trading in sweat equity to build more equity more quickly, but the benefit here is that it can help you pull out enough cash to reinvest faster if that's something in your plans. The build also helps with future financing because your debt to income ratios are much better on the Laneway suite. So if you are running into roadblocks with financing new purchases for investments, then it might be a good idea to pivot and build a backyard house to boost your mortgage ratios, which can then help you buy your next investment property. Simply put, the investment returns on a backyard house and a new purchase are different because the financing risk and work involved are also different. If you want the best return potential and you are willing to take on more risk because you are in a growth stage in life, then a new purchase is actually preferable as long as you can qualify for a big enough loan. If you are in another stage of life where you just want good, stable cash flows to fund your lifestyle, then the build might be a better idea for you to get you better cash flows. And if you can't figure out what might make more sense for you, just reach out to us. Here on our Elevate team, we're a real estate investment sales brokerage based in Toronto and seasoned local investors ourselves. When you work with our team, you're in good hands. You have our team's complete support from start to finish, including renovations advice, leasing, and property management. And if you want to learn more about this, just reach out to our team and I'll link how to contact us in the description below. Again, don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn to hear from us more regularly. You can also head over here to check out our other videos. Thanks so much for watching and see you in the next video.